Alright, Ji. So let's continue further about IFRS 2. So in last lecture, we studied that there are certain terminologies that you always need to consider when you're talking about share-based payments. So with one of the terminologies that we discussed, we are going to continue further. One terminology was that we talked about vesting conditions. Now, vesting conditions are those conditions that must be met in order for the holder to be eligible to, exercise that particular option that he or she has. Vesting conditions are the conditions that must be met in order to become eligible to exercise the grant. Those are vesting conditions. Now there are certain there are further subclassifications in vesting conditions that you need to understand. For example, there are two types of vesting conditions. One are known as market-based vesting conditions, and the other one are known as non-market based vesting conditions. What do you mean by market-based vesting conditions? Market-based vesting conditions are those vesting conditions that are linked to market prices or market indicators. Sir, then what do we mean by non-market based vesting conditions? Now, isn't it really obvious? Non-market based vesting conditions are those conditions that are not attached to any market price or market indicators. All right. So for example, this is YY and he has been offered a share based payment. How will he get this particular share based payment? He will have to fulfill some vesting conditions. Now there can be two types of vesting conditions, either market based or non market based. Market based vesting conditions will be those conditions which are linked to any market factor, and non market based vesting condition will be those conditions which are not linked to market factor. Sir, can you give some examples? Oh yes. Market-based conditions, one of the examples can be an increase in share price. For example, the CEO or board of the company, executive board of directors of the company are giving a remuneration package. They are told that they will get, for example, 1 million shares as remuneration, as bonus, as a share-based payment if they increase share price of the company by 10% in next 1 year. Or maybe just 10%. Maybe it can be a scenario, it is not time bounded, and the executive directors are told, you see, we have made you the executive directors of the company, we are the shareholders of the company, we'll give you a certain bonus in forms of share based payment, you just increase the share price by 10%, 20%, or 30%. Now since increasing share price is a market factor, this type of condition will be known as a market based condition. Another example can be an increase in shareholder return. For example, if you see Dragon's Deck, or for example Shark Tank, these video shows that are there, you must have seen there are in certain shows you see that the angel investors invest in a company, and they give the directors a certain target, and based on that they are basically remunerated. They are told that you need to increase the market capitalization or our shares value by another $100 million, and if you do so, we will give you 1 million shares extra. We will approve your 1 million shares extra. Now this is a market based vesting condition. It can be a condition for the salespeople, for example, that if you increase our market share from 40% to 45%, we will give you a share based payment. Now since market share is a market based indicator, it will be known as market based vesting condition. Sir, can you give an example of a non market based vesting conditions? Plenty. For example, one of the most common examples that is used in your exams is service period. One of the most common examples used in your exams. So, for example, you tell your employee that Mr. Yasir, if you work with us for another 3 years, or maybe 5 years, or maybe 10 years, we will give you a share based payment. Now, employment service is not a market based factor. These are just employment services. So this is known as non market based vesting condition. Or for example, some business unit heads may be given a non-market based vesting condition that you need to score an EBIT of, for example, 15% for this year, and if you do this we will pay you certain amount of shares. So you need to achieve a certain target. This is the vesting condition that you need to fulfill. EBIT, earnings before interest and tax, of 15% for this year, we will give you certain amount of shares. All right. It may be a sales target, it may be a restructuring target. One of the examples of a non-market based vesting condition. For example, your seniors, your heads may be given a target that if you reduce our abnormal losses by 10%, reduce headcount by 20%, do lean this and that, if you reorganize the company, we will give you certain amount of shares as a remuneration package. So they are given a condition that they have to fulfill, and this is a non-market based vesting condition, restructuring target. All right. So these are two types of vesting conditions: market-based vesting conditions, non-market-based vesting condition. And then there is further subclassification into non-market-based vesting condition. There are two types of non-market-based vesting condition. Either there is a non-market-based vesting condition which is with service condition, or there is without service condition. You understand? Non-market based vesting condition can be a with service condition target or a without service condition target. Sir, what do you mean by with service condition or without service condition? You see, with service condition is a vesting condition which is time bounded. For example, I call my employee and say that you have to work with me exclusively for another 3 years, and then you will be entitled to 100,000 shares. Right? So this is a share-based payment because we are offering them shares in against of their employment services, but this is time bounded. There is a vesting period defined, 3 years. Whenever there is any vesting condition which is time bounded, what do you mean by time bounded? That the time period, the duration has been defined. This type of vesting condition is known as a with service condition vesting condition. And what do you mean by a without service condition vesting condition? An example could be when there is no time bounded. For example, you have been given a target that reduce abnormal losses by 10%, reduce it. And whenever you reduce our company's abnormal losses by 10%, we will give you, for example, 100,000 shares. Now, in this example, the other person is told about a particular vesting condition, but the time period has not been defined. All right. So, as and when the abnormal losses have been reduced and the target will be met, he will be given at that date, which is not known yet. At that date, he will be given shares. That will be the vest date. In the first example, we knew that, okay, year 0, Mr. Yasir has been offered a particular share option, that is the grant date. And since the requirement, the condition was that you have to stay in employment for another 3 years, the time period was defined. It was a with service condition vesting condition. Since year 3 was supposed to the vest date, the time period has been known. But in this scenario, since no time period has been defined, the vest date cannot be defined, and as and when that particular target has been met, the vest date will come. Sir, one thing that we don't understand, that why do we bifurcate conditions into with service conditions and without service conditions? Why do we distinguish between them? Because there is an accounting impact. You see, IFRS 2 requires that if the vesting condition is a with service condition, with service condition means that the time period of 3 years have been defined. The employee is going to provide you services for 3 years. The time period has been defined. So IFRS 2 says that if the benefits to the entity, by employment of Mr. Yasir Yamin is going to come in 3 years, if the benefits are going to come in 3 years, then the expense should also be recognized in 3 years according to matching concept. So for example, in the first year, 1/3 of the expense must be booked. In the second year, 2/3 of the expense must be booked. And the third year, 3/3 of the expense must be booked, because in 3 years, the organization will benefit. So in with service condition transactions, since the time is known, since it is a time bounded transaction, the expense of share-based payment should also be recognized based on that time period. Expense is recognized over the period. But in case of without service condition vesting conditions, since the time is not known, that I don't know when will the condition may be met, you can only recognize an expense of this payment at the vesting date when the condition has been met. So if a question comes into your exam that is a with service condition vesting condition, then you will recognize expenses based on 1 out of 3, 2 out of 3, 3 out of 3, or maybe if the vesting period is 4 years, 1 out of 4, 2 out of 4, 3 out of 4, 4 out of 4, and so on and so forth. We will do that in our practice questions, don't worry about that. But the expense has to be recognized over the period. But in cases of without service condition vesting condition, the expense of share-based payment can only be recognized when the condition has been met. You cannot do anything in advance. All right. So this is, here we talked about vesting condition. In each and every question, we are going to identify which type of vesting condition has come in our exam. Okay. So now let's move forward, and before we even start some example questions and we see the numerical part of this accounting standard, we still need to understand fair bit of certain logics as well, and thereafter we can proceed with the technical stuff. I just told you about types of vesting conditions. Now before we move on, we also need to know about types of share-based payments. This is because there are primarily two types of share-based payments, and both have different accounting patterns. This is a very important lecture, okay? So please understand what I'm trying to say. Basically, there are two types of share-based payment. One is known as equity settled share-based payment. All right? One is known as equity settled share-based payment. I usually call it ESSBP, equity settled share based payment. And one type of share based payment is known as cash settled share based payment, or CSSBP. I'll repeat it again. There are two types of share-based payment transactions. One is known as ESSBP, equity settled share-based payment. Just repeat after me, equity settled share-based payment. And the other one is CSSBP, cash settled share based payment. Now, sir, what is the difference between these two types of share based payments? Equity settled share based payment transaction is a transaction in which the holder will be settled in the form of shares. Any share based payment transaction in which the holder is promised that in exchange of goods or services we will pay you in the form of physical. By physical I mean it can be electronic as well, obviously. I mean you will be paid in the form of shares. This type of share based payment is known as equity settled share based payment. Now there is another type of share based payment which is known as cash settled share based payment. Sir, what do you mean by cash settled share based payment? Now, cash settled share based payment transaction is a transaction in which the holder will be settled in the form of cash based on the value of shares, or if I may say, based on the intrinsic value of shares. Cash settled share based payment is a type of transaction in which the holder will be settled in cash based on the intrinsic value of shares, intrinsic value of options. Sir, we don't understand why would the holder be settled in cash. Okay, we remember the definition said if the cash is based on the value of shares, it is also a share based payment. Okay, we get it. Sir, but why intrinsic value? You see, you remember what was the formula of intrinsic value? Intrinsic value was fair value minus exercise price. You see, it would be very dumb. A person comes to the company and says, you see, you had promised me that you will pay me in cash, in the form cash based on the value of shares. So this person says, okay, you had to pay me cash based on the value of shares, and today I see that the value of shares is $10, so you pay me $10 on the shares. But the company says, wait. We will pay you $10 per share as agreed between us, but for that you have to pay us $0.5 of exercise price as well. So doesn't it seem absurd that I am going to get $10 but I'll have to pay $0.5? So I take out $0.5 from my pocket, I give it to the company, they record a transaction, and then they pay me $10, and then I record a transaction. Wouldn't it be so much convenient that the entity netted off these two amounts? I had to pay the company 0.5 and they had to pay me $10. Why don't they directly pay me intrinsic value, which is $10 minus 0.5? They can deduct the exercise price and certainly give me $9.5. Very simple. So basically, cash settled share based payment transaction is a transaction in which the holder is paid in the form of cash based on the intrinsic value of shares. All right, by intrinsic value it means that the exercise price is already deducted. Okay, now we know that equity settled share based payment is a transaction in which the holder will be paid in shares, and cash settled share based payment transaction is a transaction in which the transaction will be settled in cash, intrinsic value. You know, in your exams, the examiner doesn't write that, okay, this question is for ESSBP or this question is for CSSBP. It doesn't distinguish like that. You know what your examiner actually does, and it actually reflects the market pattern as well. Whenever there is a question of ESSBP, that is equity settled share based payment transaction, the examiner mentions that transactions in the form of share options, or I call it SOPs. Whenever your question entails or question says that this transaction refers to share options, you always remember share options is an example of ESSBP. Whenever you see share option written, it is an ESSBP transaction. And likewise, whenever there is a transaction which mentions share appreciation rights, or as I commonly call them, SARs. Whenever the question talks about SARs, it is understood from an examination point of view that we are talking about cash settled share based payment, or CSSBP. Now, don't get confused by what do you mean by SAR. A SAR is just a piece of paper like a share option was. But unlike where in share options agreement it was written that we will pay you in the form of shares, in SARS it is written that we will pay you in the form of cash. So both are basically piece of papers, but the market and the real life market and your examiner distinguishes these two type of piece of papers, that share options are those agreements in which shares are promised, and SARS are those agreements in which cash is promised. So basically these two are same agreements but with different payment terms. All right, so whenever share options come, you will know that this is an ESSBP transaction. Whenever there comes SARS, you will know that there is a this is a cash settled share based payment transaction. Now, why do we really distinguish between share options and SARS? Because the accounting is different. If the question is of share options, that is ESSBP, then the entity will recognize an accounting entry. You see, you are paying someone. For example, if you are paying an exchange of employment services, remember, you remember that example. Why had to work for 3 years and then he'll be paid in the form of shares. So if you're paying someone if you're paying someone shares in the form of a salary, if they give you employment services and you pay them salary, so what you will do, you will debit the salary expense, the employment expense debit, and since you're paying in the form of shares, you will credit equity option. Now remember that initially you will not be crediting equity directly shares. You will be crediting equity option. And when the right has been really exercised and you are really issuing shares after the vest date, this equity option will be debited. All right. And at that date, share capital and share premium as the transaction requires will be credited. But the first day, it's an option. On the vest date, on the exercise date, they really become shares, but on the first date, it is an option. So what accounting entry you're going to make? Salary expense debit, equity option credit. Sir, but what if we are offering share options against plant and machinery, the acquisition of plant and machinery? So no problem. You will make an accounting entry, plant and machinery debit, that means asset debit, and again equity option credit. All right. So this is the accounting entry that you are going to prepare. Now, sir, what is going to happen in the case of cash settled share based payment? You see, cash settled share based payment transaction is a transaction in which the other party is not paid in the form of equity but is paid in the form of cash. Since there is an obligation to deliver cash, you might have understood that we are talking about a financial liability. You remember IFRS 9, a financial liability? Obligation to deliver cash was a financial liability. Now we are not going to call it a financial liability, but it is a financial liability. We'll rather make the entry expense debit. For example, in exchange of services, we'll do expense debit and not equity option credit, but I'll just call it liability credit. And you, oh, by the way, you can call it financial liability, your financial liability credit. And when on the other date, when the exercise date or the vest date comes and you are actually paying cash, you can debit this financial liability. And when the actual payment is made, you can just credit cash. All right. Again, the question is, sir, what if we are buying goods and we are promising cash settle share based payment? If you're buying goods, what you will do, you will debit the inventory. And since you have an obligation to deliver cash based on the value of shares, you will do financial liability credit. So this is the accounting entry that you're going to prepare. All right. So in equity settled share based payment, the entry is expense debit, equity option credit. In cash settled share based payment, the accounting entry is expense debit and liability credit. Expense debit, equity credit, expense debit, liability credit. Understood? Now the third point that I want to make here is, now you know the accounting entry, right? You know that expense is going to be debited, and equity option is going to be credited. Now you know this. But now the question is that, sir, what value is going to be used for the debit or credit? How are we going to measure that transaction? So according to IFRS 2, an equity settled share based payment transaction, or if you simply call it a share based payment transaction, is measured at fair value, market value at grant date. Whenever you make this accounting entry, now listen carefully. Whenever you make this accounting entry of share-based payment transaction, equity settled share-based payment transaction, you are going to make this accounting entry by fair value, and fair value which is at the grant date. Now remember, grant date is the first date. We are not talking about reporting date. We are talking about grant date. You remember year zero date, the date at which options are granted. The fair value at the grant date is going to be used to record this accounting entry, expense debit, financial equity option credit. Now, since we are going to use fair value at the grant date, not the recent date, but the grant date, it means that there is going to be no mark to market revaluation. Do you understand what is mark to market? I call it M to M. Mark to market means that whenever you update a certain value from here to the most recent price here, it is known as mark to market. You are going from point A, this mark, to the most recent market value, mark to market. We revalue. All right. So in equity settled share based payments, you are not going to do any mark to market. No mark to market is going to be done. That means you are going to always use fair value at grant date. No mark to market will arise. No mark to market is acceptable. Now the question which comes into your mind is why? Why no mark to market is allowed? You know why? You know why? I'll give you a very crystal clear example. You see, accounting is based on consequences. Accounting is based on consequences. For example, there is YY company. All right. And there is Mr. A. I ask Mr. A, you work for 3 years for my company and I'll give you 100 shares of the company. Mr. A says, okay. Now just stop and clearly think for a while. I'm YY company. I promised Mr. A 100 shares. Just think how I would have arise to the concept of 100 shares. The case would have been, the case would have been, the case would have been, I would have thought about it in my mind that I want to pay Mr. A, for example, $1,000. And today, shares are worth, for example, $10. So I would have promised him 100 shares based on the fact that I wanted to pay him $1,000 for his services, right? And this is how I would have come to the conclusion that okay, 100 shares are okay for Mr. A. Since I've promised him 100 shares, since I have promised him 100 shares, if the value of these 100 shares after 3 years goes to, for example, $20, who will benefit from this market revaluation? Me or Mr. A? The holder, not the company. For example, the share price of these 100 shares goes to $5 per share. Who is going to lose? Mr. A. I'll repeat it again. I promise Mr. A that if you work for me for 3 years, I'm going to pay you 100 shares. At that time, I thought that okay, today shares are worth $10. I wanted to pay Mr. A $1,000, and therefore $1,000 divided by $10 price, it means 100 shares would be enough for Mr. A. Now, after 3 years, if the price of these shares goes to $20, I still have to pay him 100 shares. I promised him shares. I didn't promise him cash. I promised him shares. I still have to give that person 100 shares. If they are worth $20 nowadays, he's going to win. If the shares are worth, for example, $1 after 3 years, he is going to lose. So the mark to market risk, the fair value risk, the risk of price movements is not on the company in the case of share options, it is on the holder. Since there is no fair value risk on the company, therefore, no mark to market or no fair value revaluation is done by the company. The holder is at risk. The shares price may go up or down. I'm not at risk. I promised the other person 100 shares. I have to pay him 100 shares irrespective of what the price is after 3 years. So since an absolute shares have been offered, not the value of shares but absolute shares have been offered in the case of equity settled share based payment, the price risk is on the holder, not on the company, and that is why no mark to market is allowed, and hence you are just going to use the market value at grant date, the original date. No reporting date fair value will be taken. There will be some questions that you will see that fair value at reporting date is given, but you are going to ignore that. All right. Now, if you look likewise, what happens in the case of cash settled share based payment transaction? In the case of cash settled share based payment transaction, the measurement criteria is to use fair value at reporting date. Why fair value at reporting date? That means that you have to mark to market with the changes. You have to report mark to market changes. But why? Obviously, that in the case of cash settled share based payment, you had promised the other person cash based on the value of shares. Now, if you have promised someone that after 3 years I'm going to pay you cash which is equivalent to the intrinsic value of 500 shares, there is a good possibility that the market may go up or the market may go down, and as a result of that you may have to pay more or less after at the vest date. Hence the exposure of fair value changes is upon you, hence all mark to market changes must be reported. Hence measurement should be done at fair value at reporting date. Now, in order to summarize whatever we have studied, just repeat after me. Equity settled share based payment is a transaction in which the holder is promised shares in exchange of goods or services. Example, share options. Accounting entry is going to be expense debit, equity option credit. We are going to use fair value at grant date. That means no mark to market changes. Equity settled share based payment is done. Cash settled share based payment. Cash settled share based payment, the holder is paid in the form of cash, which is based on the intrinsic value of shares. Example, share appreciation right, SARS. The accounting entry is going to be expense or asset debit and financial liability credit because there is an obligation to deliver cash. Number third, there you are going to use fair value at reporting date for measurement. That is, mark to market changes will be incorporated because the exposure is all upon us. Now that is all about share based payments. I hope you really understand this, because on the basis of this we are going to move further. Now, in the next session, we are going to study about numerical examples, numerical questions of equity settled share based payments. I hope you liked it. Thank you very much. Have a good day.